Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. There was a host of data making the headlines yesterday. Japan and UK in a technical recession, weak US retail sales data, and of course, our very own merchandise trade deficit shrinking. Global markets, like previously, did not react much to this or have any big volatile moves. Morning, JK, your thoughts on the recent data, as well as I would like to hear your thoughts on the Indian data, which seems to be better, but of course, rupee did not have much of a reaction. Your take on that?
Good morning. Yes, as you said, there was a lot of data from US yesterday to digest, and following that stronger CPI number, which had pushed the dollar up, we have seen retail sales yesterday falling 0.8%, and minus 0.1% was what expected. And even the previous month number was revised quite a bit, and that gave a lot of uh, you know comfort for the bond traders to once again start expecting that rate cuts may not be too far away. Definitely not in March. May hangs in balance, and June definitely. So that is how the in fact the bad news from the economy has been taken as good news by stock market, again pushing higher strongly, particularly in the Dow Jones, covering the broader economy stocks. And so, in fact, the investors have been shifting from one index to another. Sometimes preferring the new age stocks and sometimes the core economy stocks. But overall, the markets are have been doing well on the hopes that eventually rates are going to be cut, not only in the US but also everywhere. Because we also had a GDP number from UK that showed the economy is in recession. Now, look at it in a broad sense. Two major economies, Japan and UK, are in technical recession. Germany and in fact the whole of Euro region just managed to avoid one. And if the current bond markets do not gel with the economic scenario, explanation is that GDP is a picture in the rear view mirror, and same rear view mirror also shows US economy growing exceptionally strong. Now, there are quite unique reasons for these differing scenarios. Europe mostly affected by high rates, high inflation, Ukraine war, and Chinese slowdown, while UK economy had its own reasons like reduced trade, weaker business investment, and labor shortages that came about after the Brexit. Now, in Japan, consumers never seem to open their purse enough, as depicted in the big fall in consumption data. US consumers had so much of money credited to them post-pandemic that they continued to spend despite higher prices and the wealth effect from the stock market. Now, what is the front view? There are signs consumption is slowing significantly in the US, as evidenced by retail sales yesterday. In fact, the Conference Board's leading indicators on the US economy continues to be in negative territory, and the board expects the economy to be in the mild recession in Q2 and Q3. In Europe, we are seeing signs of bottoming in economic activity. Recent industrial orders from Germany, Eurozone industrial production, and ZEW surveys all indicate. In UK, the finance minister's plans to cut big taxes by reducing public spending. Japan is dilly-dallying on its shift from negative rates. The expected big rise in wages and buoyant stocks are hopefully leading to better spending and GDP growth in Japan as well. Now, what I can visualize is as economies slows further, US will take the leading cutting rates and the rest will follow soon, as has been seen historically. And that shifts the economic picture bright in the rest of the world too. China is also expected to come out with strong supportive measures to support their economy and the markets in the coming days. So we might be, just to give the broad picture, I think we are in the cusp of a growth dynamic shifting from US to the rest of the world. And that's good news overall. But till then, of course, we have the suspense about when the process of monetary policy change will start. Now, as far as the dollar is concerned, that did not really reflect the overall change in the sentiment after the retail sales, although it continues to move in the range. It did not break the lows which was seen before the CPI data. So dollar structural issues of a record debt and fiscal deficit keeps it less preferred by reserve managers looking for alternatives in euro and GBP. They are the ones which also did not weaken much despite the numbers that we saw yesterday. So there is a kind of conundrum in which the currency market is placed right now. whether to go on the weakening picture for the US going ahead, or on the basis of the data which is coming mixed from UK and Europe, as well as Japan. So that's why we are seeing the dollar continue to be in a range. My bias is that eventually dollar is going to go down, because they will cut rates first. They will also cut rates more than other economies, and that will keep the dollar resisted above 1.05, 1.0550, or maximum 105 or 106. That's the maximum that I see for the dollar index. GBP well supported at 125. We saw yesterday the MPC member also coming out saying that this was the recessionary data was expected, and future looking data is good. And in Europe also, the rate did not break 1.07 despite many efforts. So at best, a range for the dollar for the short term, and likely to fall further on going forward. Now, as you asked, in India, rupee, of course, in a range bound action continuing. But this time it cannot be grudged also, because we also have the dollar index broadly moving in a range, and we did not react much to a rise in CPI number. So the rupee maximum high was 83.1011. So even the retail sales did not evoke much response yesterday in the offshore market. So rupee continues to be in that range until we see a decisive move in the major currencies, or the flows start flowing in. But on the macro data side, the global trade data of India is again something to cheer about. We had better goods trade deficit yesterday, falling by more than 2 billion compared to previous year. And we had a fall in imports as well as exports, but imports fell much more, and to read the deficit at 17.5 versus 19.8 in the previous month. Now the goods deficit is 9-month low, and the overall deficit is almost balanced. I mean, when you combine the services and the goods trade, you have a deficit which now reads at just a 0.7 billion or 700 million, and that is quite a significant change compared to what we saw in December at 5.17 billion, or year back at nearly 4 billion. So if we maintain the trade balance around these levels, I think current account is likely to be a very insignificant deficit. Some hopefuls or some optimists even say it can be in surplus. As Mr. Das pointed out in his speech in the monetary policy, India's current account is eminently manageable, and their focus is more on managing the large flows that are expected in the coming months. So again, for rupee, again, I would say short-term rangy, but as we enter into a period of larger flows, which are eventually going to happen, and also the dollar index fall that is also anticipated, I think rupee's bias continues to be for one of strength in the medium term. Until then, we continue to see the range between 82.80 and 83.20. Thank you.
Thank you, JK. And quickly summarizing, and when it comes to US, we had a weak retail sales data, including revisions to previous data, and it provided some comfort to the rate cut bettors. And as JK mentioned, bad news is taken as good news by the stock market, which pushed higher. UK GDP, if we look at the overall growth picture of other DMs, UK GDP showed contraction, while the EU economy mildly missed a contraction, largely remaining flat. So US economy continues to be an outperformer, but outperformer in the DM segment. So for how long is the question? For rupee, we are seeing a range bound action, and as JK mentioned, if we maintain the current trade balance numbers, our current account can even end in a surplus. That's quite possible. That's it from us today. Thanks for listening. Tune in on Monday for the latest in the financial markets.